All right, guys, welcome back to another episode of Mad Money. So you can see that we're above $400,000 again. So we're about $5,000 from the highest the account value has ever been. But that being said, that was about a month and a half ago before some of these downturns started happening and before I started adding additional capital to the portfolio. So with the additional capital of the portfolio added, we're still down around $36,000 from all-time highs if you were to have it on a normalized basis. So things with that are that today's video, I just want to talk about a little bit about Cardone Capitals, an update, an email that I got from Grant himself or maybe one of his employees. Give you a brief overview of the portfolio once again, and then look at the overall market as a whole. Look at back at the 10 years, 5 years, last month, last 3 months, and the last 5 days to kind of get an idea as to what sectors are performing the best. And then maybe if I think we have time for it, if it doesn't go too long, I'll jump into maybe my two largest accounts and kind of show you guys what stocks I have in those accounts. So let's just hop right into the video and we'll kind of get after it here. Let me actually hide some of these things here so we can kind of just jump right into it. So, jumping over to uh, the analysis of the YouTube channel. Currently, we're looking at about 72% of you guys are not subscribed to the channel. So this is the second or third video that you guys have watched and you enjoy it. Make sure to hit that subscribe button. But I really want to give a shout out to my women watching the channel. We're up to 5.8%, which is huge. I think about a year ago, I started calling out YouTube for not having an equal viewership of men and women on the channel. I think it's a huge disservice. I meet a lot of women on the channel that are huge into investing, and I think for some reason that the finance sector just gets skewed towards male viewership. I don't necessarily know if that's for ad reasons or what, but just huge shout out. We've got this up from about 1.5% all the way up to close to 6% over the past 28 days. So really proud of that, and also proud of the other countries stepping in. This has steadily been on the decline for specifically the US, and it continues to grow in Canada, UK, Germany. So love to see the other international countries kind of coming in and viewing the videos, even though might not necessarily pertain exactly to the stocks that you might be investing in. So that's pretty awesome. But hopping over now to the Grant Cardone Capital update. So Grant just sent us a note, give us an update about April collection. So he was basically just mentioning the fact that we have about 92% of rents that have been collected, which I guess, I don't know where he got the 74% for the national average number, but got 92%, partially probably due to the fact that they're giving some discounts for the next however many months. If you pay rent this month, you're getting some discount on your rent, so at least it's going to be able to collect a little bit in terms of rent. Might not be full, but that being said, they are withholding distributions for the next 90 days. So that means April, May, June at least, I won't be receiving my normal distribution that I've been kind of receiving over the past, I guess, 7-8 months. And so I'll make sure to edit that in the future part of the video here when we kind of look at the annual income that I'm expecting for 2020. So now just hopping into the actual portfolio overview. You guys are used to this at this point. Portfolio is up to about $405,000. 12-month forward income was around $14,300, which is pretty good considering my goal for 2020 was $14,000. But that being said, we're in April looking at a 12-month forward income, so we'll talk a little bit more about that in a moment here. Looking specifically at the income and the value by sector, income being on the left, value being on the right. Energy in terms of value has come down pretty drastically. It's now almost in alignment with real estate financials, which is pretty nice because now that kind of gets us to a point where it's about 48% of the portfolio. Consumer staples is up there, healthcare, industrials, all are kind of in alignment with being about the same value. So just a step behind the energy, financial, and real estate sectors. Cash being about 7.2% of the portfolio at the moment. telecommunications being about 6.2%, and information technology coming up a little bit from where it was in the past, but it's still way below at about 4%, and materials being about 3%. In terms of income, it's still massively overweight in terms of energy. It's about 31% of the income coming from energy. Have yet to receive any dividend cuts in this particular round of the downturn in the oil markets or oil and gas markets. But I'm sure in the next month or two, some things may be coming out of some of the lower quality stocks that I have invested, maybe some more of the speculative investment energy stocks that I have. But financials and real estate is around 16%, just like their capital value on the right hand side of the pie chart here. And then healthcare 6.6%, industrial 6.6%, materials about 4.7%. Telecommunications sector is about 6.5% here, and then cash, because it's a very small yield, a little bit less than 2% at the moment, still have yet to receive a cut from American Express. Sitting about 2.3% of the income that I'm getting from the portfolio. So looking pretty good, and I'll touch a little bit more about this in the next part that when we kind of jump into everything, but I'll probably be highlighting the large chunk of the portfolio. So about 80% of the portfolio, which is in Fidelity, which we'll kind of hop into right now. So about 345,000 of that 405,000 is in my Fidelity accounts. Now, some of these might be 529 accounts for nieces, nephews, and stuff. So there might be a thousand or two that isn't necessarily actually mine, I could say, but I don't count that in my portfolio value. That's just kind of extraneous money that I have for family members that I don't count in my own personal money. But yes, 345,000 of this is in Fidelity. So some of you guys give me garbage about me not really having a estimate of what and showing you guys actual accounts. Well, here's Fidelity. There's the 345,000 where the majority of my money is. Keep in mind, I also have M1 Finance, Robinhood, Cardone Capital, and a couple other portfolios that I kind of look after outside of my Fidelity portion of the portfolio, my IRA, individual brokerage account, and 401k. So we'll touch a little bit more about that in a moment. But what I really want to look at now is really looking at things over the past 10 years or so by sector. And so what this basically has here is the sector, and maybe we can actually dive deeper into industries as well, which would be kind of cool. But this is where I want to spend the majority of the video kind of looking at the returns that you would expect coming from each one of these sectors. So first and foremost, just to kind of state, we're looking at the 10-year kind of growth here. So you can see everything between the past day, 5 days, month, 3 years, 5 years. But we're looking at 10 years here, and we're kind of organizing it by highest return to lowest return. So real estate has been a separate sector, not for very long. So I think it's been within the past 5 years that real estate's kind of been split off from financials, I believe they were in the beginning. So that being said, that currently doesn't sit anywhere in terms of positives, because obviously it wasn't there 10 years ago. Energy is only one that is actually negative, but kind of jumping back up to the very top with the most positive is information technology, then consumer discretionary, healthcare, consumer staples, utilities, all pretty good. You could see that really the only outliers with respect to where the average is, so the average you can see basically is like consumer staples, utilities, industrials. Apologies for that. The ones that are severely below that are financials, materials, communication services, and energy, being negative for energy. And on the upside, the outliers are information technology, consumer discretionary, and healthcare. The average being about 135% returned over the past 10 years. So basically, doubling your money and then some over the past 10 years. And so that's pretty interesting to see, but keep in mind that that was a bull market. So had you invested in great companies like Google, Amazon, Netflix, maybe being part of that, Facebook, maybe being part of that as well, you'd be up about 293%. Or maybe if you just invested strictly in the NASDAQ, it probably would be skewed heavier towards this as well. Looking maybe more into the past year, it's around the same, although utilities has kind of jumped up and consumer discretionary has kind of dropped off. But you see a little bit more over the past year of differences in terms of gains. Some of that, I think, is just based off the fact that we have had this volatility, and so you do have some of these companies that have been severely whacked in terms of capital value or market cap over the past 12 months, just based off the fact that things have kind of been relatively even keeled to the beginning of February, and then things really started to take a dip. So everything is basically down, given the exception of consumer staples, healthcare, utilities, and information technology again, with energy still leading the pack in the negative direction, followed by industrials at a very far behind, about 17%, and then financials being 12%. But looking at the past 3 months, so just in total past 3 months, so this is basically looking from beginning of January to where we are on the 9th of April here. Utilities has actually been the sector that has held up the best. Information technology down about 9%. Energy still down over 40%. So it's not looking good for energy in any of these at the moment. And then financials are down about 25% as well with industrial. So that's looking pretty crazy. And then let's just obviously look at, well, the month is kind of when we started, so a month and a half ago is when we really started seeing this volatility. So let's just look over the past 5 days. You kind of have this recent bull run over the past week and a half in the market. So one of the best market runs since the 70s, I think I saw, which is pretty crazy if you think about it that way, almost 40, 50 years at that point. So pretty crazy. So basically, real estate's the one that's kind of leading the pack over the past 5 days, 20%. This is evident by some of the real estate companies that I invested in. They really took a deep dive like 3 weeks ago. So they were holding up relatively well until about 3 weeks ago. A lot of them started nosediving. I think what it was that people started acknowledging that some of these dividends and distributions were going to be suspended. And once those started happening with some key real estate investment trusts, I think that the entire real estate aspect of the market started dropping like a rock. And then there are some of these companies that do have higher quality assets in them that have been really allowing it to kind of come up, followed by materials, financials, utilities, consumer discretionary. So keep in mind, some of these were the hardest hit in over the past 3 months to a year, including energy as well. And so that's why I don't think you're seeing information technology grow as much as it has over the past 5 days, is because it didn't really decline that much to begin with over the past 6 weeks or so since we started seeing this volatility. Same with healthcare, communication services, and consumer staples. Consumer staples is sort of interesting because they did get hit pretty heavily. Anyway, and then yeah, so that was pretty interesting to see with respect to how things have kind of been forming out over the past couple weeks here. But what I really want to look at now is maybe how badly some of these companies have been hit in terms of the industry that they're in. So whether that's airlines, whether that's oil and gas, or what have you. So um, actually, now I'm curious what the past 10 years have looked like. So internet and direct marketing retail. Don't necessarily know exactly what that is, but 1,200%. If you were to invest in that, software, technology, hardware, storage, life sciences. So I guess this is like biotech, and then biotech itself, healthcare technology, all above 200% return. So above average return of about 130% was the average return for a stock over the past 10 years if you were to kind of be looking at the S&P 500. And then let's just look for the past year. It's very similar kind of area here. Biotech being up in the top five, food and retail. Now let's kind of look the past 3 months. So the same. You kind of have internet direct marketing, metals and mining, biotech. But a lot of the other sectors over the past 3 months, which is interesting, are negative, with the worst being, I would anticipate, actually being energy somewhere. I can't see it yet. Banks, distributors, automobiles, oil and gas, I think that's down 41%, so it's not anything different than what we would be expecting. And then over the past 5 days, I'm curious. So, auto component parts, 30%, automobiles, 28%. That's pretty interesting. I wouldn't expect that. Consumer finance, 26%, real estate, 25%, banks, 20%. That's something I could expect. Chemicals are up. I know that. I have some investments in chemicals. Airlines are up 17%. Energy components. That's pretty interesting. Who's doing the worst over the past 5 days? So it looks like everybody's still up. There's no individual industry that is down. I'm not exactly too sure why gas utilities, marines, and all these are not showing up. Maybe it's just they don't have the analysis for it. But let's just see over the past day. Is there anybody that's negative? Over the past day, there are some. They're relatively flat, except for semiconductors and energy equipment services, which I thought was pretty interesting. Okay, so that's pretty cool. I'm curious what other material they kind of have in here with respect to business cycle. So this is one of the reasons why I love full brokerages, is that you kind of get these analytics that some of the smaller companies like M1 Finance or Robinhood don't have, and that's not a hit on them by any means. But I thought this was kind of cool. I haven't seen this for quite some time. This is as of March 2020, and so the last time I checked, we were kind of like in the mid, so just about to start coming down in terms of the growth cycle, which I think is kind of cool. And I think that that was probably June 29th. So got lost for a second. Um, so yeah, looking at this bad boy for March 2020, you can kind of see what you would expect. And one of the other cool things is when you have a sort of full length brokerage, you can, or full service brokerage, you can kind of get these sorts of things that kind of provide you an idea as to in late and recession time periods where you should best keep your money, that are either going to perform better than the market or what. And you know, this is kind of cool to see. But in the late term value of the market, which is kind of what we're in, leading into a recession here, you'd want to be in materials, consumer staples, healthcare, energy, utilities. In a recession, you would want to be in consumer staples, healthcare, and utilities. And what this basically is showing is, on average, for recessions and through business cycles, these are the sort of materials you would want to be invested in, or companies or sectors you'd rather be invested in. And this is just based off of trends, right? So it's not a guarantee that with the current cycle that we're kind of seeing, because it is slightly different than a financial one. It's kind of a pandemic-led recession, rather than a financial-led recession, in that kind of scenario. So things might be different, but this is kind of interesting to kind of lean back on in terms of where you should be investing in the market. And actually, Jim Cramer wrote about this in one of his books as well, which I handed to a friend. I don't remember what it was called, but interesting, interesting read. And he kind of talks a little bit about the business cycle and where you should have money and when, and relatively interesting to see with respect to that. But one of the cool things in utilities, you can kind of see a clear pattern throughout the entire life cycle, as well as information technology, and consumer discretionary and real estate. You can kind of see you want to be in real estate when it's really starting to boom, and during a recession, you don't want to be in real estate at all. So, really cool to see. So that obviously would mean if you have a lot of money, and you want to buy into something, buy in a recession for these companies, because they're going to be down, way down. So you know, when it gets down to the back of a recession time period and you're about to start being in, coming up into a recovery time period, you should be buying into some of these real estate, information technology, and industrials, which is kind of cool. And probably want to start selling out of healthcare because it's a more conservative approach during a recession, which I thought was pretty interesting to see. Now, actually going into the portfolio, let's just take a quick look at the companies I have in my individual brokerage account. I think I showed you guys a little bit as to, let's clear all these, a little bit as to how the portfolio is kind of doing with respect to the overall value of it and whatnot. But what I really want to show is the companies I have in my Roth individual brokerage account, and probably just those two, because that holds the majority of the value. The 401k at the moment is about 50-50 cash, S&P 500. That was based off the fact that I was going to slowly start to drip money in. So that covers about 35% of the total portfolio there that we don't have to cover. But in terms of companies that I have in my individual retirement account, we have BHP here. I have about 146 shares for, at the moment, a return of about $2,000 or so, 88% return. This is way down from where it was before this sort of volatility in the market started happening. You really started to see the impacts of it kind of showing up relatively early on, but this price is down from the 50s, mid 50s, I think, over the past couple months. So that is just one thing to kind of keep in mind. Then you have Cyrus One, which actually just paid me a dividend earlier this morning. So 76 shares of that, up about 50%. Wish I had bought a little bit more during this downturn, and I think maybe I did, because I remember originally only having about 40 shares, 50 shares. But anyway, Disney, I wish I had bought during this recent volatility in the market. Still holding about 51 shares, currently even on my position. So I got in, the past couple years with a decent price, about 103, but I wish I had bought a little bit more. So First Solar is looking pretty good, back up to the $40 range. Holding this one for the long term, about 30% up or so. Then you have some of my materials stock here. This is a chemical company, LYB. Don't know how to pronounce the name, but the financials and the balance sheet looked phenomenal. So even though I don't know how to pronounce it, the underlying stock and the company look great. My cost basis is horrible, about $85 or so, but in terms of where we're at, it looks like the price has kind of come up a little bit. I think it was down into the 40s at one point. So I think this will be a long-term hold forever, and continue to just grab those dividends and buy them as I can. Main Street Capital down a good chunk as well, so it was about 39.26 in the cost basis of the portfolio, and at the moment it's sitting around $26 per share. So not looking so hot on Main Street Capital, but overall it's performing pretty well for me, besides the past 3 months or so. So can't complain with that one. Then you have Philip Morris. That one is a $92 cost basis. So that one's not looking too hot either, but at the same time, we're only down about 10% due to some of the dividend reinvestment that I have in Philip Morris. Then you have South 32, which is a spinoff of BHP. I don't really keep track of this, and I'm surprised that it's only down 30% or so. Virgin Galactic is one that I have as a spec play. It's only $1,500 in the portfolio. A lot of people give me grief for this one. Keep in mind it's $1,500 out of a $4,000 portfolio, so relatively small, way less than 1%. It's probably less than less than a third of a percent, maybe we'll just say less than 0.5%. So a lot of people give me grief for having that in the portfolio, and it's a relatively small position. So if it goes belly up, I'm not really going to be hurting all too much. And that's generally how I keep the portfolio. If it's a company that I know that's high quality, it'll be a larger portion of the portfolio. I don't generally gamble and do speculative investing with the portfolio. This is one of the very few. Then you have Verizon, which has performed relatively well. It's a relatively small portion of the portfolio as well, though, at about 0.5 percentage point. But I also hold this in my individual brokerage account, as you'll see in a second here. Then you have WP Carey. This is a decent position as well. Bought this around $61 or so. It's currently sitting at about $70. So this is down from about 80, 85, maybe even hit $90 before this recent volatility in the market. So it's down quite a bit, but pays me a pretty hefty dividend, so can't complain with that at all. Now let's just hop over to the individual brokerage account, and we can go ahead and look at that bad boy. So we'll cross off the Roth here, and we'll do individual brokerage account and look at it. So this has expanded in terms of number of positions, probably more than I would like. And that being said, I think over the next couple months, as some of these stocks sort of recover from where they were, I'll probably try to trim down on some of the ones that I do and do not want. just based off the fact that some of them are probably just in here because, they were legacy positions that I bought very early on in my career and have just kind of been holding on to them, but really should probably just sell them at this point if they're not going to really return. So things like Chesapeake and Seadrill Partners were bad investments where I've lost, probably $4,000 or so in terms of total value, and they'll never come back. I mean, but that being said, it offset heavily by by a lot of the gains that I've seen in the portfolio as well. So you do win some, you do lose some, and you have enough positions in the portfolio, you can kind of even out and offset a lot of those losses. So biggest one of the biggest positions here is AbbVie. So it's about up about 15%. This took a huge dive like at the end of 2019, and so I was purchasing in along with a lot of other folks purchasing into AbbVie, and I think it was just based off their Allergan merger. So ex-dividend date coming up here and should be paying me, I think in mid-May as well. So can't complain with that one. Boeing is a newer position that I recently entered as the market has kind of come out of favor with it. It's up about 14% overall. I have thought about trying to swing trade it a little bit to lower the cost basis, but at the same time, it's one I plan on holding for quite some time now. So I know some folks, like independent investor, have had some success day trading it or swing trading it rather, and being able to lower their cost basis. And I can understand their philosophy on it. It's gotten hit way hard. I don't think it's going to be that impacted. It does have a chance of bankruptcy for sure, but I think that chance is relatively low. So I think people have been swing trading this one for good reason. It has been seeing a lot of volatility in the market, just like a lot of these positions. But one of the stocks that I wish people acknowledge, and I've seen this in some of the Facebook groups that I'm in, including our own. If you want to join that one, link in the description below. But this price is back up to $471 a share. It was literally $105, $106 cheaper 2 weeks ago, and that's when I purchased the most recent position. I added 2 shares, not a lot, but up to 8 shares of this bad boy. Can't complain. Pays a pretty good dividend, $14 per share, $14.50 per share. So yeah, I mean, it's not huge. It's a 3.5% yield depending on when you buy into it. But I mean, this thing grows the dividend like crazy. I remember it was $8 just a few years ago. So then you have Bryn Mawr Bank. Have this bad boy. Not bad. Only down about 10 to 15%. Bank of Nova Scotia should be paying me, I think, on Tuesday as well. So this one's down about 16%. Then you have BP, which is down about 28% in the portfolio. BP Midstream Partners, which is a midstream company that pays a huge dividend. If you were to buy into it now, it's about 14-15%. I think that's covered for sure underneath all the taxes, or not taxes, the pass-through rates that kind of come in through the pipelines that they have. That might be impacted if we're forced to cut back on the amount of oil and gas is being produced in the Gulf of Mexico, us being the United States, and that might take an impact into BP Midstream Partners as they produce less rates. They have to then pay less in tolls, or the oil companies have to pay less in tolls to the company to be able to pay the distributable cash flow. So give you a brief overview on that. Then you have Caterpillar here, which is, I've added to this as well. I bought at a good price at about 119 or so back in October. This just gave me an opportunity to buy 14 or so shares at $105, and then I think a couple more a little bit later on, about another 15 shares or so at about $100 or something like that. So that lowered the cost basis from 119 to 110. I'm happy with that, sitting on a 14% gain at the moment, and it's just a high quality company. I mean, I'm living in Trinidad and Tobago now, and you still see Caterpillar products, Caterpillar machinery, and everything all over the place. So I mean, it's an international company that does business everywhere. So Chesapeake down way on that, almost 99% down on that. So relatively horrible part of the portfolio. Then you have Cheniere Energy, which is LNG, down about 20% on this bad boy. GEO Group only down about 10% on this. Wish I'd bought a little bit now. It's almost up to $14, but it was last time I checked, it was in the $10 range. So definitely could have almost went up about 40% just based off of that. Any additional capital that I bought, that one should be paying me at the end of the month as well. So excited to see that. I think that'll be my first dividend payment from GEO Group. So excited for that. Then you have Google, Johnson and Johnson, of course. Johnson & Johnson being one of the biggest portions of the portfolio, or positions in the portfolio rather, at the moment. So about 73 shares of Johnson & Johnson. Hadn't really purchased too much of Johnson & Johnson because it didn't really dip too much below my current cost basis. So if it does dip way much less than that, I will be buying. I know some people got it in the 120 range, but I did not, unfortunately. Cosmos is one of those speculative energy stocks that I have, so down about 72.5% at the moment on this one. But I'm cautiously optimistic that it'll come out on top in the very long term. So could be a bad position. Could go bankrupt for sure because it doesn't have the sort of cash flow from downstream assets like some of the super majors do. But I think they were relatively well positioned for some sort of downturn. I don't think that they're the best positioned, but at the same time, they weren't super over leveraged as well. Then you have another position in Main Street Capital, down only 6% on this one. So I'm happy with this. I think it'll continue to kind of be okay in the long term. 3M down about 8%. That's fine with me. Haven't really been buying and lowering the cost basis. Have been in other portfolios, but not for the individual brokerage account, just because it's already up to about 47 shares, about $7,000 position. So Altria Group, this is another one that's only down 6-7%. Can't complain with this, about $5,500 position. Realty Income, this is one I've been adding to for sure. So I bought 50 shares at about $48 and 50 shares at about $41. So added about 100 shares. So the cost basis at the moment is down to about $52.90, so that's pretty good. I can't complain with that. So on the shares that I bought, I'm up, a huge margin. From 41 or 48 to 56. So that puts some buffer in it. But this is a monthly dividend paying stock, so I'm going to hold this bad boy for a while. Yield on cost at the moment is about 5.3%. So one of the better names in real estate. So can't complain with that at all. So I'll hold my 5.3% yield on my investment and seek any long-term capital gains. So fully anticipate that this one will be going back into the 70s soon when things recover. PepsiCo didn't lower my cost basis in this at all over the recent times. You can kind of see here that we're sitting on 40% gains. This isn't because I bought recently. This is because I bought strategically, I would say 3-4 years ago when it was back in the $90 range. It dipped from like 120 down to 98, and so I bought, I think. And I was like, that's a good price for it. And I haven't seen good prices coming for Pepsi since that point. So there's a lot of other opportunities. Do I like Pepsi? Yes. If you don't have it, should you get in the portfolio? Absolutely. But I just didn't see a need to add to the position because I don't think that the company has really grown that drastically since when I bought it at $98. So if it came down to $90, I'd be buying, but I'm not going to be buying in the $120, $115 range, which is where I kind of was seeing it over the past couple weeks. So Phillips 66, this was one that if you were able to buy into it at the $40 range, I would have, and I probably should have as well because my cost basis is relatively high, but there was other energy positions that I'd rather get to, one of which being Royal Dutch Shell, which is the next one here, only down about 7.3% in terms of my position in Royal Dutch Shell, so $6,300 position at the moment, 172 shares, yield on cost about 9%, so can't complain with that. Cost basis down to about $40, so can't complain with that at all. And we're currently sitting at about $36 and change. So well positioned for when this stock fully recovers in the future, if it does. If oil prices return in the future, definitely will be excited about that. Stag Industrial sitting about a 56% gain on this one. Added about 20 or 40 shares or something like that. During this last recession, I guess it was 23 shares because I originally had 100 shares of Stag Industrial. So bought 23 shares or so, lowered the cost basis a little bit. Actually, the cost basis went up a little bit That was a lie, but hadn't seen this one back in the $21 range for quite some time. So decided to add a little bit to it. Can't complain. You have Starwood Property Trust only down 6.3% due to the dividend reinvestment. So I've almost gotten 20 additional shares just from dividend reinvestment. And so yeah, that's some of the perks of dividend reinvestment. If this fully recovers, things will look great. AT&T just bought another 50 shares of this bad boy, lowered the cost basis down to $30.87. Originally, cost basis was $31.24 for about 209 shares. Then I added 50 shares at $29.32. That brought the cost basis down. So it's sitting on 274 shares, sorry, at a cost basis of $30.87. So fully anticipate that this is going to go back up to the $35 range at least. In the medium term for sure. Long term, probably back up to the $40 range. So didn't really buy this one for the capital position. Bought it for the dividends. It's a high quality company in a relatively decent market. So can't complain with that at all. U.S. Bank, this is another one that's supposed to be paying me, I believe, on Tuesday. So I think this will be my second dividend payment from these guys. Still down about 30%, so maybe add that dividend back into the company. I think it's going to be relatively small dividend, so might be able to get a share or two from that and buy back in. I mean, we're at 38 bucks, so any ability I can lower this to below $50 a share, I'll be happy to do that. I was buying it at $60 a share. I was buying it at $50 a share, so any ability that I can get to get this cost basis to below $50 a share, I will do. This was my strike, I believe, of the past six weeks or so. 20 shares of Visa. It's not a huge position. I wish I bought 40, 50, maybe even 100 shares, but at the time I was trying to limit the amount I was buying every single day. So instead, I bought a $2,700 position here in Visa at 136 bucks. I think that's a pretty good price considering this stock is down from $230 a share. 27% up at the moment. I know it's a relatively low yield, but they grow it at about 10, 15, 20% every single year. So hoping that this one will be a long-term contribution to the portfolio. Don't plan on selling it anytime soon. Then you have Verizon here, who's been a long-term staple in the portfolio. Oh, I have 110 shares. That's nice. Okay. For some reason, I thought I had a 50-share position. So $6,300 position in total, up about 32%. Didn't buy any Verizon over the past couple weeks just because the cost basis I had on it was relatively good. So would need a little bit lower of a cost basis for me to add additional capital to this position. Wells Fargo is one that I've been a net buyer of over the past couple of weeks for sure. Didn't buy it at the very lows. I should have probably. But overall, we're still down about 24, 25%. I think this is one of the biggest positions that I have in terms of cost basis in the portfolio, and also at the moment, I guess, market value as well. Sitting at about $10,000 in terms of market value. So for sure, if the dividends keep coming in for this bad boy, I'll probably continue to add if I can get this cost basis to below 40. I mean, that's just going to be game changer. But part of me wishes that we kind of had a 2008 sort of time frame. I would definitely forego dividend payments to get a company like this in the single digits, just like it was in 2008 time frame. People that miss those kind of boats, are kind of kicking themselves, I'm sure. So I'm hoping for some sort of scenario like that. I would forego dividend payments for 2 to 3 years for sure to be able to acquire the company at that good of a price, because I think people were able to pick this up for like $8 or something like that, and at the moment it's yielding about $2.04 every single year. So yeah, you're getting a 25% return on whatever you invested every single year. You could use that to buy more Wells Fargo, buy other companies. So yeah, I mean, that's why Warren Buffett was like, "Hey, Bank of America, here's your cash, whatever you guys need. I know you guys are upholding the economy and really helping things out." So. But yeah, that's relatively it. That's all I really wanted to cover in terms of today. I know we touched on a lot of different things. We touched on the portfolio value, some sectors, how things have been performing, some Grant Cardone Capital sort of material as well. So really hope this video finds you guys great. Hope you guys got a lot of value out of it. And if you guys have any comments to ask down in the comment section down below, let me know. More than happy to talk to you guys about anything. And yeah, I think that's it. I'll see you guys in the next video. Cheers.